Hi there, everyone. Welcome to Ainslie's Gold and Silver Standard Insights. I'm Joe, and as always, we're joined by Chris Tipper, and joining Chris today is Josh Lang. Hey, guys.
Hey, Joe.
All right. As always, what we do here at GSS Insights is we discuss the morning's news, which is posted on ainsleyBullion.com.au. As always, I will share the screen so you can follow along at home. This particular episode, this particular piece of news was called "It's All About the Fed Liquidity, Stupid," why S&P 500 $3,500 by year end. That's a really big call. Chris, what do you make of this?
Yeah, thanks, Joe. Yeah, it is a big call. And there were some really great insights and analysis actually with those charts. They came from Real Investment Advice today. And they're worth digging into a little deeper. So we'll have a go at that today. The title of the article, like you said, it's all about liquidity, stupid. That's a bit of tongue in cheek, but it's a reminder of the long-standing rule in the markets that you simply do not fight the Fed. The point being that because the central bank ultimately is responsible for money supply, they can create or destroy an effectively unlimited amount. So no investor, pretty much regardless of what they're investing in, can profit from being on the wrong side of a relentless central bank policy. It also feeds into that popular saying that the market can remain irrational for longer than you can remain solvent. So, it doesn't really matter how right you are. So it's not about what should happen. The market will figure that out and get there eventually. But in the meantime, the investors who profit and make money will be the ones on the right side of the trend of what actually is happening right now. So that's what really pays to understand some of the key points from the article today. I suppose sort of first and foremost, it's all about liquidity, and right from the title, it highlights that. Real Investment Advice, they developed a model that was discussed in there in the article today that predicts, like you said, the S&P to be down at around 3,500 by the end of the year. So, Joe, if you can actually pull that chart up to give us an idea of what that sort of move might look like.
Yeah, sure. Here it is, right here. So we're looking at that on this is the 2 weekly time frame, just out of interest.
Do you want to show us where that level would be, 3,500?
Yeah, absolutely. So here we are currently at 4,274 US dollars, that is, of course. So I'll pop in this horizontal line right here. And a quick plug for my TA Tuesdays. Take a look at gold, silver, and crypto. That's every Tuesday on the channel. Subscribe. But around about $3,500 is right here. So a little bit lower than the previous one.
There, isn't it?
Certainly is.
Yeah, right.
So they're predicting 3,500, yeah, by the year.
That's what their model is, end of year. Yeah.
Wow.
So I suppose there's a few assumptions at play in that model, but that's the result they expect if the Fed delivers on their forecast in terms of tightening through raising the rates and withdrawing liquidity through the other means that were also discussed in the article. So I personally see a very high probability that the Fed won't be able to deliver on their forecasts, as I've discussed a few times on Insights now. So I don't actually see that graph or those levels necessarily being hit, because I think they'll be forced to pivot faster than they expect. But of course, I need to listen to my own advice from before and not fight the Fed. So for the time being, let's assume those predictions are correct. And looking at that chart, that's about 18% fall. So that pretty significant amount still to come from that if that happens. So the model they're using was focused on a few main drivers that determine the amount of liquidity the Fed is providing. So, Josh, I know you were diving a bit deeper into those this morning. Would you be able to give us a bit of an overview?
Yeah, absolutely can, Chris. So that first chart in today's news is showing that the Fed's not pulling any punches at the moment with their attempt to really quickly cool off the economy. So the chart, Joe's got it up on screen, great. This is showing the Fed's Reserve Repurchase Program, or RRP. This tool was, for the most part, unused, as we can see in that chart, up until 2021. So RRP is used to temporarily remove liquidity from the banking system. So when that chart's going up, you can effectively see that liquidity is being pulled back, and you can see just by the scale of that it's being very aggressively done. So this is their attempt to counteract inflationary pressures at the moment as quickly as they can. I'll get you to just scroll down to that second chart as well, Joe. because it's also quite interesting. We're showing how they're using liquidity at the moment. So this is the TGA account. The US government runs that for most of its day-to-day business, and it's managed by the Fed. So when citizens, business, all those kinds of people receive a government check, they deposit it at a commercial bank. The Fed then debits the Treasury's account and credits the bank account at the Fed, increasing its reserve balance. So the TGA sits on the Fed's balance sheet as a liability, along with notes and coins and bank reserves. But as we know, the Fed's liabilities must match its assets. So that drop that we saw there must also rise with bank reserves and vice versa. So that massive spike low that we're seeing in that chart is liquidity increasing in the banking system, and that is what made lending and investment in the wider economy much, I suppose, easier through that pandemic period. This is another factor which has, now that we're here at this point, led to those 40-year high inflation rates, and also what led to the S&P growing so incredibly quick out of the pandemic. So those two charts together just reinforce what you were saying, Chris, that liquidity is just everything at the moment.
For sure. And thanks, Josh. There's really a lot to unpack there, actually, but it's great to be reminded, I suppose, of the mechanics of these things that we often gloss over. We tend to bundle it up as liquidity, and it's easy to forget that there's actually several parts that are all moving at the same time and they're all involved. So each one can have a fairly significant impact independently. So it's a lot more complex than it first seems, I suppose.
Yeah, absolutely. You're right, mate. Yeah, there's a number of factors involved. The market has been so inflated for years because of how easy monetary conditions have been. With interest rates being ultra low, banks have just been able to print money in the form of QE. But one factor that's encouraged investors put so much money into the markets, particularly S&P, as we can see that that chart going up, is how willing the Fed has been for the last few years to keep that market afloat. So, for so long now, the Fed and other central banks globally will just not let that market fall beyond a certain threshold. I think we've seen maybe 20 to 25% before they just come in and rescue the day with lower rates and more QE. So I suppose this time around, the question is, can they do that? Or have they sort of backed themselves too far into the corner with inflation now? So,
which is what we've been discussing and what we've been arguing really for the last week and a bit.
Yeah. So inflation's particularly worrying market participants at the moment as the Feds, began tapering in November. And as 2022 has progressed, several other factors have weighed down sentiments too. We've had the invasion of Ukraine, which led to, the rise in energy prices, which just increased inflation even more over the globe. And then rising inflation meant that the average consumer now had less money to spend on goods and investments as well. And then we still have other analysts seeing the cash rate go up by another 1.75% by the end of the year. So, that alongside all the other headwinds at the moment means that maybe we can see the S&P fall to 3,500. I know
if all that comes together,
if it all comes together, but my opinion is if that's going to happen, it's got to be sharp, aggressive, and really quick. And the main reason because of that is because of debt at the moment. So that sheer scale of debt globally in the financial systems means that markets just can't fall for an extended period of time. That long-term drop could just set off a terrible chain reaction of bad debts that could just destabilize everything, even big banks. So this time is probably going to be different. Inflation has never been a problem before in this era of, the Fed doing anything they can to keep the stock market inflated. The Fed's running the risk of seriously damaging their credibility here. Not to mention potentially grave political consequences as well involved with that. But as we've been saying here on the Insights show, the path forward isn't really clear, and that's kind of the problem. But no matter what the path is, I think it's going to be a hard one. No matter what way it is, whether it's that really sharp decline down to maybe 3,500, or even if, maybe the Fed just slowly sucks all that liquidity out of the system over a multi-year period, that's going to hurt as well.
And it seems unlikely that they have an attention span that long to do it over a multi-year period, I think sometimes. But yeah, that's some really great analysis there, Josh. And thanks for sharing your thoughts on that. I think to sum up from my perspective, this modelling we've discussed today is something we need to consider here in Australia, as it does impact us directly. So often we think it's just US, and it's mentioned even in the article, you go, oh, US Fed, we always talk about the Fed. But it doesn't really matter whether we think we're immune from the consequences of the Fed playing with the leaves of liquidity. The reality is, don't fight the Fed remains true, as the impact from more or less liquidity of the world's reserve currency, which is, of course, the US dollar, it's going to flow through to us and asset prices everywhere, one way or another. If the analysis we've looked at today proves to be correct, then we're either at or very close to a turning point right now. And I would say we can expect a new leg lower. Most markets is probably about to begin after the gains we've experienced recently. So I'm still personally optimistic for the markets, as I'm expecting that early pivot. But for now, let's wait and see if the Fed actually does follow through.
Keep the eye on the Fed. That's absolutely right.
Always keep an eye on the Fed. Fantastic. Now, gentlemen, if that concludes the discussion for the day of this morning's news, I have a question for you, Chris.
Yep.
Are you ready? All right. I'm going to share the screen. What is this little thing that popped up over here? I mean, I did happen to put it up myself, but what's going on here? This is GSS crypto buy and sell signals. Chris, why don't you give us the hot tip? Sure. The hot tip on your tips. What's going on?
Yeah, sure. So today I've launched my first charts video, which is, as you said, those daily buy and sell signals. That's up there on the Ainslie YouTube channel. Yep. Basically, this is a daily video where I analyze the crypto markets and provide actionable recommendations. And I'll do that 5 days a week using my proven trend following strategy. So I'll then go a step further, actually, and dollar cost average into my portfolio. So I buy some of my favorite chart of the day in real time, so that you can see it on the screen and you can follow along. You get to see my entire process and my actual performance when you do that. And as far as I'm concerned, it just doesn't get any more transparent than that. So it's not just a recommendation that has no sort of consequence. I'm actually following it through and actually doing it live, so you can see all that happen. Today, crypto, the buy sell signals we looked at were on Kronos, Bitcoin, Ethereum, and others in there. So I think it's worth heading over to the YouTube channel to check it out, and we'll no doubt continue to improve the production quality as we go. But it's a start to get it up there and out for everyone to have a look at.
I think it's going to be very popular, in my opinion, particularly because it's daily. So, and I love the fact that you give actual buy and sell recommendations, and you put your money where your mouth is, and you do, and it's going to be great to track that portfolio over time and see that journey that you've gone on. So I'm looking forward to seeing it every single day. Now I will wrap up. I'll wrap up if you guys don't have anything else, I'll wrap up with the usual. If you have questions about the morning's news, send your questions into insights@goldsilverstandard.com, but also head over to the Discord channel. That's discord.gg/gold. And that's where myself, Josh, Chris, or one of us, or even all of us will be on Discord straight after you see the upload of this particular GSS Insights video to continue the conversation. Let's talk about the S&P 500. Let's talk about what the sort of larger global impact of that is. So head over to Discord right now. As always, we want you to like, share, and subscribe. And always, as we say at the very end, balance your wealth in an unbalanced world. Thanks for watching, and we'll see you all next time.
See ya.
See ya.